Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss Pragmatic Asset Allocation Model for semi-active investors.
Hello everyone, my name is Radovan Vojtko and CEO and Head of Research at Quantpedia. Today's video will be a little different from the previous videos. We at Quantpedia are mainly dealing with trading strategies with quants and traders who trade shorter time frame like daily, weekly, intraday, etc. But today's video would be interesting mainly for investors. So that's somebody who is not exactly interested in day trading or would like to have a life and do not like to spend time reading financial news, etc. So it will be about investing strategy and how to build core part of your portfolio, how to actively rebalance it with a consideration on tax efficiency, low fees, etc. Video will be about the strategies that are called global tactical asset allocation. We wrote an article about this kind of the strategy from this space. If you are interested in more strategies which are from this space, you can of course go to Quantpedia. We have quite a few of them, more than 40 in our database. So it's not the big part of the database, but those are the strategies that are very useful for ordinary investors because they do not rebalance very often and usually just use ETFs to trade. And they can have very interesting returns even that they are not very active. How is our article called? It's called Pragmatic Asset Allocation Model for semi-active investors. Firstly, it's asset allocation model, so it's a model that will tell you which assets you should have in your portfolio based on current macroeconomic or a global political situation in your portfolio and based on how they performed in the past. And it's for semi-active investors, so it's not for somebody who would like to sit and read news every week or every month. It's up for somebody who would like to rebalance the portfolio on quarterly or yearly basis. Primary motivation behind this article is because we read a lot of papers, we understand global tactical asset allocation strategies. We read like hundreds of papers about that, and the majority of them require relatively frequent rebalancing from the point of view of the ordinary investors, because the portfolio balancing is usually done on a weekly or monthly basis. Yeah, I mean, this period, it may seem like really boring and slow for the traders who like to trade on intraday or a daily basis, but fans of GTAA strategies are not traders. I mean, they are investors. Usually they do not like to spend a lot of the time reading news, rebalancing portfolio, etc. Trading is not their hobby, so they would like to do something else. But on the other hand, they do not want to hold just the passive buy and hold portfolio because they see it as very inactive, very inert. When something really important happens in financial markets, like there is a crisis or something like that, stocks are going down, there is a high volatility, it's very hard to sit tight. And in this case, they would like to do something with their portfolio, but they want to have a rules. I mean, what to do with the portfolio. And we recognize this demand for semi-active strategy. So we wrote this article, and this article will be published also as a paper. So we build pragmatic asset allocation. So what are the main features of this article and this strategy? So firstly, we wanted to reduce the frequency of rebalancing and retain all of the positive characteristics of GTAA strategies. So we wanted to have a globally diversified portfolio. We wanted to include multiple asset classes, and we wanted to have a protection against the downturns. But we wanted to have a strategy that is not active a lot, so it means you do not need to rebalance every week or every month. We propose a quarterly rebalance, so once in a quarter, with a minimum of 12 months holding period. So we use a trenching. The trenching method is explained in our previous article, but I will get to it. How does the trenching work? So we only rebalance a specific pre-selected portion of the portfolio every quarter. In our case, it's 1/4 of the portfolio is rebalanced every quarter. So 25% of the portfolio is rebalanced every quarter, and the minimum holding period is 12 months. Why minimal 12 months? So in many countries, there are exceptions to taxes if you hold securities for more than 12 months. So for example, in the United States, a long-term instead of short-term capital gains tax is applied to profits from selling an asset that's held for more than 1 year. And the tax rate can be 0 or 15 or 20%. I mean, depends on your taxable income and filing status. So what does it mean? So generally, long-term capital gain tax rates are lower than short-term capital gain taxes everywhere. And as it said, there are only two certainties in life, debt and taxes. So we want to really optimize the taxes and to minimize the taxes that you can pay when you rebalance the portfolio. I mean, that's really goal number one. The strategy draws inspiration from a lot of the papers. The first one is probably the Maben Faber's GTAA or asset class trend following strategy. So I can recommend you to read his paper. It's very good paper. Then we already wrote our own paper about how to avoid equity bear markets with the market timing strategy. So we have a paper about that. We have a strategy about that. So you can read also this one. This paper strategy is only about the equity market, and the main feature of the GTAA strategies is the multi-asset nature. So we wanted to move from our paper that was about how to time the equity market, how to avoid bear markets in equities, and we wanted to broaden the scope of our model and include other assets, and that's pragmatic asset allocation. That's what is this article about. And then we draw also inspiration from other papers, mainly Keller, Koenig, and Antonacci. They are proposing a dual momentum, and they use crash protection, which is also our case, and we use it also a lot. So we combined all of the main findings from our paper and from other works of the other people, and we brought you this novel approach. I'm not afraid to say that it's a novel, because we are the first one that built a GTAA strategy that involves trenching, quarterly rebalance. We want to maximize exceptions, so the minimum holding period is 12 months. We have a very long time horizon, so we start the backtest in December 1927. So it allows us to have a historical analysis or backtest of our strategy that's nearly 100 years old. We also incorporated the yield curve predictor and replaced cash with the hedging portfolio. And we use the stop loss mechanism. And at the end, when we apply all of these layers, our strategy has an annual return of 10%, Sharpe ratio over 0.9, and maximum drawdown of only minus 24 or 25%. That's probably the maximum that you can get out of the GTAA strategy that's not so active as ours. Let's get to it. I've explained everything shortly. So what are the data? We are using our own database of global factors. So we spend a lot of the time to build our database of factors, and from those factors we selected 5 assets that our GTAA or our pragmatic asset allocation strategy is using. So first one is the Nasdaq 100 index or tech stocks. We use the tech stocks proxy because we want to have exposure to dynamic nature of equities with all of the ups and downs of the innovations that stems from the tech stocks. Then MSCI All Country World Index. So it's a global equity index. It includes stocks from 23 developed and 27 emerging markets. Approximately 50% of the index is allocated in US stocks because the US market is the biggest one. But it's our main proxy for equity risk, and is really globally diversified. There are stocks from all the main countries, and it's significantly less volatile and risky than other 2 indexes that we use. It's significantly less volatile, less risky than tech stocks, of course. Then we use MSCI Emerging Market Index, and the index tracks the performance of stocks from emerging market economies. Those countries are considered to be in the early stages of industrialization. They have higher growth potential, but also higher risk than developed markets. So once again, we pick one globally diversified index, that's the core. And then we picked 2 high beta sectors or regions. The first one are the tech stocks, and the second one are the emerging markets. We will try to move from the global equities to one of those regions or sectors to increase our exposure to equities or to higher performance if the time is right. And if the time is not right, we have 2 assets that can be as a hedge. The first one are 10-year US Treasuries. So the changes in the yield can signal investor sentiment about economic conditions, inflation, etc., etc. And the second one is the gold, which is considered a hedge against inflation and safe haven asset during times of economic uncertainty. So those are 5 assets that we will use, and we will move between them. I would like to spend some time to explain what is our reason for the selection of this investment universe. So as you may notice, we do not have some alternative assets like commodities, real estate, a lot of the other assets like corporate bonds, emerging market bonds, crypto, etc., etc. So we are not saying that the model will be worse with them. It's quite the opposite. So we tried the other variants. If you include other assets, the model will be even better. The reason why we wanted to trim down the number of ETFs in our portfolio to the minimum is because the ease of execution. We wanted to preserve the diversification, of course, but the more assets would increase diversification. But a lot of the semi-active investors, so the investors who are, let's say, not fans of financial markets, but on the other hand, they would like to do something with their portfolio, they do not want to juggle a lot of different ETFs categories. So we omitted a lot of possible additions from our model, and we stick just to 3 risky assets: tech, world stocks, and emerging market stocks, and then 2 + 1 safe assets, so US Treasuries, gold, and cash. Additionally, having less assets, it simplifies the job of obtaining the sufficient history for all of the assets. We built the emerging market proxy for 100 years, and it was a hard job in itself. I will not explain how we did it. It's really topic for another article. We will probably write it in the future. If we want to have more assets than 100 years of history, we will spend even more time on it. So we shrink the investment universe to those 5 assets plus cash. And there is one more thing that needs explanation. So why we picked emerging market, tech, and global equities as the main risky asset. So once again, the model from which we started to build the asset allocation model is our paper Avoid Equity Bear Markets with the Market Timing Strategy. So it's this paper. But this paper was about the equities. We wanted to retain the usage of equities as the the primary driver of the performance. I mean, we understand, we acknowledge that there are other risky assets and they offer premium, like commodities, real estate, corporate bonds, crypto, infrastructure, collectibles, etc., etc. However, we consider equities to be the primary risk asset that has a lot of advantages, and is mainly liquidity and the ease of access. So they are liquid and you can easily buy them, and they offer sufficient premium. Other assets, they have some shortcomings in some of the characteristics, like liquidity. So infrastructure, collectibles, real estate, they offer premium, they are not liquid. It's hard to build a model that will buy, sell them. Or they have questionable size of the risk premium, like commodities. So yeah, there is probably risk premium in commodities, but I mean, it's hard to guess how big. So it's better to use them just technically. Or they are some kind of the hybrid asset, like corporate bonds or some real estate trust. They are usually just mixture of equity and duration risk. So they do not add a lot from the diversification perspective. Yeah, and we can add corporate bonds into the model, but we will not improve the model at all. Or they do not have sufficient history. So I mean, that's the case for cryptocurrencies, that's the case for a lot of the alternatives, etc. So yeah, you have like 10 years of data or maybe 20 years of the data, but for other assets, we have like 100 years of data. In this case, we would really recommend to use those assets as tactical bet. So create some space in your portfolio, you can buy them tactically, but I mean, when you have a core part, the equities, the bonds, and the gold, I mean, this is the core part. This our model, Pragmatic Asset Allocation, will also be the core part. Of course, we wanted to expand from the US equities to the world index, and the all country index seems as the best, but we also wanted to have the ability to tilt our portfolio as to other risky assets. So equities are sensitive to business cycle. Individual segments of the stock market, they react very differently. So we can increase or decrease exposure to individual sectors like energy, healthcare, tech, or we can increase our exposure to countries or to whole regions. Like we can increase emerging market and shrink the US equities, or you can increase Europe and shrink emerging market, etc. There is not just one way how to do it and which sectors, countries, regions to pick for the tactical part of our model. But in the end, we decided to pick the emerging market because it's based on our analysis of the cyclicality of the outperformance of the US market against the emerging market region. I discussed this in a previous video. And we also wanted to have the tech stocks segment because we wanted to have a high beta segment of equities when there is a strong uptrend in equities. The tech stocks are not correlated to emerging market region. It fits perfectly our model. We do not imply that this is the best selection of risky assets, but it suits our needs the best. So of course, you, our readers, you are welcome to try different investment universes of your own. And at the end, a few words about the hedging or safe assets, which are 10-year US treasuries and gold and cash in our case. So we wanted to have an asset that works well in deflationary recession. So in this case, it's 10-year treasuries. Then we wanted an asset for inflationary periods. It can be gold or commodities or whatever. And we wanted one asset that works well when there is a recession caused by lack of trust in public institutions. So when nobody knows what will happen, if there is a war or some geopolitical conflict or whatever. So in this case, the gold and cash are the king. So in the end, we gravitated towards the classical trio. So our safe assets are cash, gold, and US treasuries. And we will let the price and the model tell us which asset is the best store of value for each period. So when we want to move out of the equities to the safe asset, we will pick something from that trio and we will let the history guide us which is the best asset at the moment. Okay, and now get back to holding period and execution technique. So as I mentioned in the introduction above, we decided to reduce the frequency of the rebalancing. So we wanted to retain all of the positive characteristics of the GTAA, but we wanted to build a strategy that is not rebalancing so quickly or so periodically. We wanted to maximize the tax exceptions. The best way how to do it is to do it via the trenching. How does the trenching work like? So you have a portfolio and you split portfolio into multiple parts. 2, 5, 4, 10, 20, doesn't matter. At the selected dates, you rebalance some part of the portfolio and then you hold that portfolio for a longer period. So for example, you can have 4 tranches like we have, 12-month holding period, so 1 year, and you have a quarterly rebalancing. So every quarter you rebalance 25% of the portfolio. When you have a longer time period, you can have like 3-year holding period, you can have 12 tranches. So you every quarter you rebalance the portfolio. Every quarter you rebalance 1/12 So it's like 8% of the portfolio. You hold this 8% of the portfolio for 36 months, for 3 years. Or you can have like, I don't know, 10 tranches. So you can have like 5 years holding period, and you can rebalance 10% of the portfolio every 6 months, etc. So this is how the tranches work, how the trenching work. We decided to use the first option. So we divided the portfolio into 4 sub-portfolios, and each part is rebalanced once per 1 year, and is weighted as a 25% of the weight of the full portfolio. So quarterly rebalancing for us is done, for example, on 21st of January, or at the end of the April, at the end of the July, and at the end of October each year. So as an example, so let's say that we have a signal at the end of year 1927. We calculate the signal for the individual tranche, and we apply 1 month waiting period. We will discuss that later, what is 1 month. And we invest accordingly at the end of the January 1928, and we hold it until the end of the January 1929, so for 1 year. And then similarly, it's for 25% of the portfolio. Then at the end of the March 1928, we calculate the signal for the second individual tranche. 1 month later, the end of the April, we invest the second 25%, and we hold it for 1 year until the end of April 1929, so 1 year, etc., etc. And same way in July, and same way at the end of the September, we calculate the signal, and at the end of October we do the rebalancing. Now we apply 1 month pause between the signal generation and actual rebalancing. So why do we apply a 1 month pause between signal generation and actual rebalancing? Because we want to be realistic. So of course the model gives better results when the tranches are rebalanced right after the signal is generated. So at the close of the last trading day of the quarter, or soon as afterward, which is usually the next trading day. But remember, we are trying to build a model for semi-active investors, so we are not building the trading model. So by postponing the actual portfolio rebalancing from the signal generation by 1 month, we give the semi-active investors enough time to perform the needed portfolio adjustment. The model is not very sensitive to actual date of rebalancing. Of course, there is some luck involved, and some days of the month can be better than the others. But this is investment model. I mean, it's not a swing trading strategy. So we are trying to capture the long-term moves in the prices of the underlying assets and not the intra-month variation. We really want to leave some gap between the time of the signal and the time when the portfolio is rebalancing. And if you are interested and you want to try to catch some intra-month lows, or you think you can execute the signal better than at the end of the next month, etc., I mean, just go for it. You may add some alpha, and we are keeping our fingers crossed for you. You can improve the model significantly in the execution, but our model is about investing, and we are trying to build investing framework. How the model works, the whole model and portfolio construction. So we start with the investment portfolio of Nasdaq, MSCI World Equities, MSCI Emerging Market. We systematically created the strategy in 6 progressive steps. So the first step is the momentum. I do not need to explain what the momentum is. If you are interested, go and read on our webpage. There is a lot of the theory behind it. So there is a belief that the assets that have performed strongly over some specific time frame will likely have the sustained positive performance in the future. And our initial strategy integrates 3 assets, so Nasdaq, World, and MSCI Emerging Markets. We employ the momentum as a first step, and we select 2 assets out of the 3 based on their 12-month performance. When we do something like that, we have a strategy that's just the momentum strategy. So select 2 assets out of the 3, invest them based on the trenching. So every quarter rebalance 1 trench. What is the performance in this case? Strategy exhibits a return of 11.48%, which beats Nasdaq by 1%, beats MSCI World by 2%, and Emerging Market by 3%. So we have a better performance because we are rotating to high beta segments, emerging market or tech, when the price signal tells us to do. So when some asset outperforms another asset, we buy that outperforming asset, we hold in the portfolio, and we increase the performance. But however, when you do momentum in just this way, you will still have a maximum drawdown 60, 70, 80% because you are always invested in the equity market. You are just changing the portfolio composition, sectors, regions, etc. So there is no way to avoid large drawdowns. So in all of the next following steps, we will try to optimize the portfolio, actively seeking to decrease the maximum drawdown, but we will try to preserve the momentum alpha, our outperformance against the simple buy and hold. So at the end, we are trying to have the better performance than all of the assets that are part of the portfolio, but with a significantly lower drawdown. As I said, do not forget that the investment strategy rebalances quarterly and always only 25% of the portfolio. So in the first tranche, we can select 2 assets, each with 12.5% weight, then 2 assets into second tranche, and 3 months later, etc., etc. So every 3 months, we rebalance 1 tranche. We buy 2 best performing assets, each one with 12.5% weight, so in total 25% for each tranche. So this is how the momentum works. We have nice performance, we have drawdown over 16, nearly 70%. In the second step, we will introduce the trend. So the trend component, I mean, if you are interested, the trend component is nicely explained in a Maybank famous paper. We use the moving average. So we select the 2 assets. If any of those 2 assets is under its moving average, then we omit this asset. Instead, we do not invest in anything. So we select 2 assets out of 3 based on the performance, giving 12.5% weight to each asset, but only if they are not in a downtrend. So if one asset out of 2 we picked is in downtrend, then it is omitted from the portfolio for the next 12 months, and only the remaining asset gets 2.5% weight. If both assets that we picked, so they had a positive momentum, but they are in downtrend, so they are under its moving average, it can happen very easily. We are not invested in that particular tranche in anything for 12 months. Trend following strategies like these are recognized in a lot of the papers, but what is our unique approach is that we are using quarterly rebalancing and we are using the trenching. So we rebalance only the quarter of the portfolio and we check the signal only once in a 12 months for this individual trench. So what is the result is that we significantly decrease the turnover of our portfolio. The resultant model is simpler. We do not need to check the signal every month. We have all of the tax benefits holding something in the portfolio for more than 12 months. What we did is we effectively mitigated the maximum drawdown compared to the first step. We reduced it significantly from 67% to slightly over 40%. But what is important to show that there is a trade-off as the return has decreased from 11.8% to 9.7%. So it's a significant hit to the performance. But we can repair that. How to do it is the step number 3, which is the cash. So what is the step number 3? So in the next step, we use cash component and put it into our strategy to enhance the returns. So we strategically allocate to cash when our model signals risk of part. So for example, when 2 of our 3 assets are in a downtrend, we choose only one that is in uptrend and we allocate 12.5% in the cash. And on the other hand, when all 3 assets are in a downtrend, we invest 25% of the whole tranche in a cash. I mean, this approach, so when we invest into the cash when we are not invested in a risky asset, increase the returns. It increased return from 9.7% to 10.4% compared to the previous step, reduce the maximum drawdown, but just a little. So we can integrate the cash into our strategy. We improve the performance, but we still do not have the performance as we had when we use just the momentum. But on the other hand, our drawdown is at the moment at minus 39%. So it's better, but there are still some things that we can do to improve this number even more. So step number 4. In step number 4, we will use the yield curve. So what is the yield curve? The yield curve is the slope between the short-term interest rates and long-term interest rates. It can show the monetary policy activity to the yield curve. So the yield curve, when we have short-term rates higher than long-term rates, indicates that there is a recession on the horizon. And in this case, it is better to not be invested in the risky assets. We explained this approach significantly in our previous article, Avoid Equity Bear Markets with a Market Timing Strategy in a third part. So if you are interested how the yield curve works and how you can use it to time the market, I really recommend to go into this article. But we will use this part, or we will use this step to improve our Pragmatic Asset Allocation Model even more. So we decided to implement this part. There is another thing that we can use from the Avoid Equity Bear Market with the Market Timing Strategy paper, and it's using the macroeconomic indicators. We tried to use it when we were building the model. Unfortunately, the impact of macro factors is limited. The reason for that is probably because we are using the quarterly balancing and hold portfolio for at least 1 year, or we hold the individual tranche for at least 1 year. I mean, the impact of the macro factors is limited, so we decided not to overcomplicate the strategy with an additional layer of macro signals, and we omitted this signal. So we are using only the yield curve signal. So when we incorporate the yield curve into our strategy, it can add significant value by effectively reducing portfolio volatility from 14% to 11.95. As a result, it can increase Sharpe ratio. It didn't increase the return, but once again, we have a little better return to risk ratios. Then we can move to step number 5. Once again, we will try to improve the strategy. So what we can do, we can build hedging portfolios. Instead of using cash as our go to asset during the risk of scenario. So when there is some geopolitical conflict or there is economic uncertainty, we can use gold and US treasuries and cash, so some combination of those assets as a component for a hedging portfolio. I mean, the gold is in general considered the hedge against the inflation. On the other time, investors seek the safety of government bonds when there is a deflation risk. And those two assets, they have a low correlation with each other, and they have a low correlation to traditional equity markets, so they can enhance our overall portfolio's diversification. How we built the hedging portfolio? So firstly, we duplicate the first two steps, so momentum plus trend, and we use gold, US 10-year treasuries, and cash. So in this case, we select two of the three assets based on their performance, but only if the risky assets are in a downtrend, and in only this case, we invest in the hedging portfolio. And we replace the cash from step 4 with our hedging portfolio. And when yield curve signal tells us to invest into, and two of our three assets, the Nasdaq, MSCI World, and MSCI Emerging Market are in a downtrend. So instead, we choose only the one. We invest 2.5% into the one risky asset and another 12.5% to hedging portfolio. So to some combination of gold, US 10-year treasuries, or cash. When we use this hedging portfolio instead of cash, it can help us to increase the return in comparison to the previous steps from 10.3% to 11.2%, so nearly by 1%. And at the same time, we can enhance the Sharpe ratio. And we, of course, can improve the Sortino ratio, so return to maximum drawdown. So that's a nice improvement, but there is still one more step that we can take to improve the whole strategy. Yeah, it will be the stop loss. So in our final step, we decided to reduce the maximum drawdown by implementing the stop loss mechanism. And let me show an example of how the stop loss works. So now let's imagine that we are in the year 2007, and on March 31st, the strategy selected MSCI World Equities, and we held them for 1 year from April 30, 2007 until April 30, 2008, because one must skip between the signal generation and actual investment. We are holding this asset. It's already the April 30, 2008. And the signal indicated that we could continue holding MSCI World longer. But however, since the 12-month period has already passed, we can sell the ETF before the April 30, 2009, and there will be no tax implications because we already reached the long-term capital gains tax period, so we already have the asset in our portfolio for longer than 12 months. If something happens and if the moving average signal changes on, let's say, May 31, 2008, we can comfortably sell 1 month later, so on June 30, without waiting until April 30, 2009, so without waiting for the additional 11 months when we normally should rebalance this particular tranche. I mean, this stop loss activation is the only time when the investor must trade outside of the usual quarterly time frame. I mean, yeah, it's a little nuisance, but the added value of the stop loss outweighs this. It doesn't happen very often. Usually the stop loss is activated only during the very turbulent periods in the financial markets when the investors want to rebalance their portfolios. And the stop loss activation, it gives them this possibility. So, I mean, at the time, investors usually want to sell something, and when we implement the stop loss, at least there is a signal when they should exit the tranche. I mean, the stop loss significantly reduced the maximum drawdown, so from 38% to 24% compared to the previous step. This is our final version of the model. So, I mean, the maximum drawdown of around 25% is likely the best we can expect from the strategy of this kind. Just to give you an example, in year 1987, the equity indexes dropped around minus 20% in one single day. So when we have a strategy that has around minus 25% drawdown on monthly data with a quarterly rebalancing and 12 months holding period, so it's a mildly active strategy, and its drawdown at around minus 25% is probably at the limit of what can be achieved. If the minus 30% is too much for you, then the only possibility is to combine this semi-active model with some passive portfolio of low-risk securities like short or mid-term bonds or cash, or you must simply use the models that are significantly more active. So there is no way how you can have a smaller drawdown with a less active model. And that's the end. To just give you the conclusion, so our global tactical asset allocation strategy represents really a new investment approach, mainly because we are trying to preserve the positive characteristics of global tactical asset allocation strategies, such as global diversification, inclusion of multiple asset classes, protection against downturns. We integrated 6 steps, so momentum, trend, cash, yield curve, hedging portfolio, and stop loss mechanisms into our strategy. We were thinking about adding other assets like commodities, cryptocurrencies, or real estate to the portfolio, but we decided not to overcomplicate things in this article. But if you wish, you are welcome to try it by yourself. What is the most important thing is that we incorporated trenching, incorporated quarterly rebalancing, and we heavily focus on tax optimization. And this is how our strategy is distinguished from existing global tactical asset allocation approaches. And another important thing is that we run the backtest from December 1927 until August 2023, so we have like 96 years of data. You can get a really long perspective on how the strategy works over different various market conditions. So what is the final performance? So we have final annual return of 10.6%, Sharpe ratio over 0.9, and significantly reduced the maximum drawdown at around minus 25%. So I hope that you liked this model. I hope that you liked this article. All of the links and all of the research papers that I mentioned in this video are in the description of this video. I hope that you will join me in the next one. So thank you very much and happy trading.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.